Well, hi, everyone. This is Bruce at Fleet Capital Management. It is late Friday afternoon here on the West Coast on the 26th of August, 2022. We're going to take a look at the markets. We were having a very nice week until today, but we'll take a look at what that means and what we expect to see going forward. Very quickly, video presentations intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell a security. Feel free to subscribe to this YouTube channel. You'll always have access to all of the analysis that we put up. And any questions, you can direct those to me at Bruce at Fleet Capital Management. And I will always email you back with answers. On our homepage on the website, you could schedule a video call if you want to discuss the details of your particular account. And you can also get to our weekly market analysis. Okay, let's start. And I'm going to flip over to my third screen. Here we go. This is the daily analysis that I do at the EOD, end of day trend analysis on the S&P 500. You can see, obviously, we were in a bear market when we started this, and then we started to get some neutral signs, a few more neutral signs. The green was starting to pop up. Then we went into a full green analysis, which was very nice to see. And then a few reds popped up on some really short-term signals. Today, with today's damage that the market did, we got a few intermediate and longer-term down signals. I don't think they're going to stay around much. I think those are going to be very short-lived. And I think that we're going to go back into a bullish phase on this market. But once again, the market can do whatever it chooses to do, and we will see. Let's take a look at some charts here. We always look at the S&P 500. SPX is the index itself. And I'm going to start with this first chart that shows my longer-term moving averages. I've got a 20-day, which is the green, 50-day, which is the gold, 200-day, which is the red. And then we have our ATR dots, and they're in a series of pairs. But when we have red and pink, or I call dark and dark, and the price is below those two levels, that indicates we're in a pretty strong downtrend. And you can see it came up to that level many times and then couldn't break through it. So these ATR levels do tend to hold as support and resistance. In this case, it's resistance from the market going up. And then in July, we went into what's called a no trade zone. We had a light green ATR dot and a darker purple dot. That's called a no trade zone until we break and we get light and light, which we did right here. And we started to have a really nice uptrend in the market. We also had the 20-day cross above the 50-day. That was another good mark or indication that we were in a strengthening bullish zone. But then what happened, and I discussed this a bit last week, is we went right up to the 200-day moving average. You can see that, and came back down. That in itself is a fairly normal practice. We will get up to a major resistance zone. We'll come back down. Look at how we came right down to the ATR level for a couple of days and then started back up. And that's what I expected to see. That's pretty normal as you take one or two or three runs at this 200-day moving average, which is a pretty strong area of resistance. Remember, resistance when you're going up is like a ceiling. And sometimes it takes a few tries to break through that resistance into blue skies, into clear sailing. We're not there yet. So that 200-day did hold, came back down to the ATR level, which did hold until today. So today we had kind of a shock to the system with Fed Chairman Powell giving a speech in Wyoming. And he seemed a bit more hawkish than the markets expected, and the market sold off pretty hard. Here's today. It was about 1,000-point decline on the Dow. It was just an ugly day. But how much damage did that do? Is that normal or abnormal? These are the things that you want to ask yourself. Number one, is it abnormal? No. When the Fed speaks, and this wasn't even a policy meeting, this was just a speech in Wyoming. When the Fed speaks and starts to share their insight, there's always, and I even said this in this morning's email, I said, we're going to have significant volatility. I didn't think all of the volatility was going to be downside volatility, to be honest with you, but we had a significant, you can see how long that bar is. These are normal daily bars. See those? And look how big today's was. Unfortunately, we closed at the bottom of that bar. But how much damage did it do? Well, we went into a no trade zone. We have this light colored ATR dot, and then we have a dark colored ATR dot. That's a no trade zone. That just means the market may be bouncing between here and looking for a few days to figure out a new direction. Hopefully that direction will be higher. And I suspect it will, but we do have, we're in this caution zone. You can also call no trade zone a caution zone. Is it a bear market? Did it break through both of these dots to create another downtrend based on ATR? Because you can go downtrend based on a number of different indicators. No, it didn't. So that wasn't bad. The other thing that's very interesting is this gold line down here. I'll try and make it highlight if I can. There it is. That's the 50-day moving average. Now that we are above, we've crossed above the 50-day, look at what happened. The prices closed above the 50-day. It went right back to the 50-day. It bounced off. 50-day is another important zone that traders look at. Went up to the 200-day. It couldn't break through that resistance. Came back down. We're still fairly significantly above the 50-day. So I'm not seeing a terrible chart here. I'm seeing a chart that had a couple of weeks of a strong run up. It couldn't break resistance. It came back down. We haven't broken through the 50-day, and we'll have to see what next week brings. So that's what I'm seeing on this chart. It's not good news because, you know, the market's lost a lot of money today, but technically speaking, I'm not seeing anything that is drastic. Let's go to another computer screen and look at Go No Go Pro. Again, we're looking at the SPX or the S&P 500 on a daily chart. I've plotted this vertical line just to show you where January 1st is. And obviously, from January 1st until the market bottom, which was in June, we were just in a downtrending market. There were no two ways about it. The market did try to break out, but it failed. It was a failed break. And we went down. Here was the low. So far, that's the low of the bear market. And we had some wiggles in here, and then the market started a very nice upward trajectory. And then it started to come back down. But just a reminder, the blue bars on this particular chart signify a strong uptrend. These aqua color bars are not downtrend bars. They are signifying a weak uptrend. It's pretty normal to have, let's go back over to this trend. We had strong up and then a weak up, and then strong up, then weak up. That's very, very normal that those colors change. It could even change into this amber color right here. That's kind of a no trade zone, but in their nomenclature, they call it go fishing, and then they're waiting for a new uptrend to resume. So the point of this is we're in, based on their analysis, and there's quite a number of technical pieces that generate the color of these bars. We're not in a down colored bar. We're not even in an amber colored bar. We're in a weak uptrend colored bar. So that's what I'm seeing there. The second thing I'm seeing here is, it's going to be a little bit harder to read, is I have an 8-day, this green line is an very short 8-day moving average, and then a 21-day moving average, and then a 50-day. Now on the other chart, I showed you how we're still above the 50. The interesting thing is, and again, it's a little bit hard to read, the 20-day is still above the 8-day is still above the 21-day. If that 8-day can turn back up, that could be very interesting. That could show that this was just a one-day event, but we'll see. The other thing, and the most important thing I'm seeing on this chart is, remember I've talked about Fibonacci retracement. So I put a line right here at the low, the last real low we had, and then I put a line right up here at the high, and then it creates these Fibonacci retracement levels. The most important ones, there are lots of levels, but the most important are 38.2, 50%, and 61.8. In a bull market, we're always going to have pullbacks. It is very normal and healthy to come back to around the 38.2 line if we can then resume our uptrend. That would be wonderful. Sometimes it will even come back down to the 50-day moving average, which is right around the 50% retracement. They happen to be very close to each other. That's normal. If it breaks that and goes down to the 61.8, I'm starting to worry that we might have a little bit of a trend reversal in here. It's not what I expect, but it is a possibility. If on Monday, Tuesday, Wednesday of next week, we don't go down much further and we start to see this 38.2, let me say it this way, if 38.2 does hold and becomes an area of support, meaning the prices go back up and bounce off this level, what that would suggest to us is we're in a very strong uptrend. It is normal to come back down to 38.2 and then bounce back up. So that's what I'm hoping for. If Monday, Tuesday, Wednesday, the market does go down, I don't want to see it break 50%. I don't want to see it break the 50-day moving average. Those would be two telltale signs that would be a warning in my book. So I'd love to see that 38.2 hold. I'm going to go back to my ATR. There's that 50-day moving average. What I really want to see is I don't want to go lower than that. And I'd love to see support hold and this come back up and then that red dot turn back into a green dot as soon as possible. And we would resume the uptrend, again, trying to break through the 200-day moving average. Because once we're above that, we have no more resistance as far as technically speaking. For right now, we would have no more resistance. So that would be a very powerful sign. So I've tried to show you both sides of the coin. On the downside, I hope we don't break the 50. I hope we don't break this other ATR level. And on the upside, we need to get this red dot back to a yellow dot. That represents an ATR, very important ATR level. And remember, ATR is average true range level, and get that back into an up mode. So that's what's happening. Yeah, today was a very bad day on the market, but that is, like I said, it's somewhat to be expected when the Fed meets and they have announcements like this. The good news is over the weekend, many traders may look at what the Fed said about how they're not going to let up. They're not going to get inflation, let inflation get ahead of us. They're working hard to bring down inflation. And quite frankly, we're already seeing signs of that. Gas prices are down 70 days in a row at the pump. Housing prices are already, well, housing sales are already starting to slump and prices are slowly starting to come back down. I have been reading that food prices have been coming back down. So I was a little surprised, and I think that's what happened today, that the Fed was so aggressive in their speech today, because we're already seeing inflation starting to weaken. I mentioned to you, maybe it was a month ago, 2 months ago, I don't remember, in one of these videos that I thought we'd already hit the peak of inflation. And I stand by that 100%, but we'll see, we will see. So I think that's what caused today's rout, if you will, is that we're already seeing inflation starting to temper itself, yet the Fed was still pretty hawkish. Hopefully over the weekend, people, big traders at large institutions will realize, hey, the Fed is kind of on our side. They want to get rid of inflation so we can go back to a more normal economy. Remember, all of this inflationary mess started with COVID, with the shutdown, with global supply chain problems, with problems getting products on the shelves, with cooped up demand. And then as COVID started to dissipate, money just rushed back into the system. This was a very, very odd circumstance. I mean, when was the last time we had a global pandemic? Not in most of our lifetimes. So they're just trying to stabilize the economy back into the normal zone they call stable. So I'm not seeing anything terrible today, other than it beat up on our returns. And our returns have been really, really impressive. The last week or so, even with down days in the market, our stock picking has been beating the market just every single day, which just confirms to me that the stock picking I'm doing is right in that we're picking very, very strong, very healthy stocks. And hopefully we'll just get rid of this shakeout and we will move forward. So that's what I wanted to show you today. Again, yeah, it was a bad day. It's an upsetting day when you see a market lose that much. But technically speaking, it doesn't look terrible. I hope it doesn't turn terrible. I don't think it will, but let's see. We're going to probably have some volatility on Monday, maybe Monday, Tuesday, and then hopefully things will calm down and really start to relax and we can go forward. So that's my take on the market for this week. If you have any questions, shoot me an email or feel free to schedule an appointment. We'll look at your specific account, but we're not in bad shape at all. We've got great stocks, great investments, and we just need this market to break through a couple of these last zones so we can go into clear sailing, if you will. All right, have a wonderful weekend. Let me know if you have any questions. Talk to you soon. Bye-bye.